Hi guys and welcome back to Yashi. Today we're going to talk about real estate. Where is the market today? Where are we seeing it going? Where are buyers and where are sellers? We know generally the pace of sellers, buyers is more of a question mark, but we're going to see in this video what the situation is. We know the Federal Reserve has been, let's say, increasing interest rates for the past year. However, we've seen a slowdown in interest rate hikes in the past couple of months. First of all, because we saw a slowdown in the inflation pace, although it's still going up at more than normal, let's say, rates. But also because we saw some issues with the banking system. SVB was the first major bank to, let's say, go under. We saw also First National Bank, and now also we saw a little bit of expansion in it, the issues with the banking system towards Europe. Will this slow down the pace? Will this invert the pace? We don't know. If you want a little bit more of details about this, there's a couple of really good channels out there. Clear Value Tax is one of my favorites. But anyway, let's get started here about real estate. We're gonna start with mortgage rates today. I'm going off with bank rate. On average, the national average of mortgage rates today is around 6.88%. According to bank rate, they can offer, with their connections and stuff, interest rates under 5.8%. I don't know how accurate bank rate is. The fact is, we can see a negative pace. We're seeing interest rates going from the all-time high of this year that was towards the end of February to a newer low that seems to be the lowest since the beginning of this year, at least when it comes to, let's say, the lowest interest rates the bank rate offers. With that said, what does this mean? This could mean that potential buyers, by seeing a lower interest rate today and a pace going down, could potentially come back to the market. A 1% change in interest rate on a $100,000 loan is $1,000 less in interest rate per year every single year, which could be more to principal or could mean a lower lower mortgage payment. It makes a lot of difference to see a 1% change in mortgage rates. Let's look at the actual market now, guys. If we go on realtor.com, we have the general data center here. We're gonna start with new listing median price. What are the prices? Where are we at? The median price of listings is still in positive territory. Actually, we're still 1% up compared to last year. Now, if we look at the median sale price, on the other hand, what is the sale price of the average house? The median sale price is actually in negative territory. To be specific, 2% lower compared to last year. Last year, we saw the biggest increase in prices because people are trying to sell and buy before interest rates would skyrocket, especially in this period here. This is when the Federal Reserve started hiking interest rates by a lot, which you can see result in very high gains. So to those people that are saying the housing market is crashing, yes, the housing market is in negative territory. Is it crashing? It's a 2% decrease in prices compared to the best year of real estate in the past 10 years. So is it really a crash? I would call it more of a slowdown compared to a crash. 2% is not a lot. 2008, the grand crash of housing, the change was in the 20s of percentages. So the market is in negative territory in terms of sale price, but not that bad. Now here's the question, where is it gonna continue going? Here's now as a matter of supply and demand. We saw that interest rates are going down, so demand might be ticking back up. And if you look at mortgage application, has been ticking back up a little bit. The question is, where's supply? If supply is high and buyers are coming back, buyers are still competing for a lot of houses. But if the supply is going down and it starts already at a low point, which is the case right now, buyers that are coming back on the market will be competing for less and less homes. More competition means increase in prices, more potential increase in prices. Let's go on the active listing on the real estate market right now. Age of inventory, active listings. So 2020, we're gonna use 2020 as, let's say, the baseline. Where was inventory in 2020? We were above 1 million homes, generally speaking, and then it started dropping as people use the low interest rates to buy houses. 2021 was worse, of course. 2022 started very low, but then ticked back up almost to 2020 levels. But then it started going down as sellers did not sell anymore because they were not incentivized into upgrading into a new house. Many of the sellers are people that already own a house that want to upgrade to something new. With interest that are now double as much compared to 2 years ago, there's no incentive in buying something else. Prices are pretty much the same. Interest rate is double. Why should I buy? Let me stay where I am. I have the lowest interest rates I can ever have in the history of the United States. Let me take advantage of this. This is pretty much the thought process I believe that is going through most of sellers. If we look at the active listings today, we're again at 2021 levels and officially under 2021 levels. We're still above 2022 levels, so inventory is better than last year, but it's still extremely low. 2021 was a very low inventory year. We're still very low. We're still not at pre-pandemic level, which means that if buyers are coming back to the market, they will be competing for less properties. Where is the pace going in the future? Will this pace continue or will we see an uptick in inventory? And this is where we have to go on to new listings in the national market. I gotta sneeze. Okay, fuck me. New listings. New listings is where the pace is going, where are we expected to see active listing coming in the future. We see that new listings, this is 2022, the light blue line, it's going up, but not at the same pace as we saw in 2021, 2022, and 2020. This is pretty much where the pandemic started. Here data, we're still under that, which means that if demand will tick back up, and this is the pace of new listings, we might see a reduction in supply, an even further reduction in supply. If we don't have new houses coming back onto the market, and as we saw in the past couple of videos I did, new housing supply is increasing for a while, but new permits are down. So the pace of construction is actually lower than it was in 2022, much lower than 2022. So if this pace continues, we will find ourselves in another market where more buyers will be competing for less houses. Again, the foundation for a gigantic increase in prices if the buyer demand increases by a lot. This is the general situation. Now, which houses will be affected and which houses will not be affected? I believe that if you look at the pace of construction, which houses are being built, and the average prices in America, which is around the 400K, 350K mark, houses that are more in the luxury sector are more affected by interest rates. If you increase interest rates by 3% on a $2 million house, that is a lot of tens of thousands of dollars of interest added on your yearly mortgage payments. However, on the lower end of rising rents, if you're talking about houses under 200K, I believe they will not be affected as much because you have rising rents on one side, people that want to get out of renting and start building some equity because let's be very honest here, this is not financial advice, but if you look at articles, one of the biggest contributors of net worth is owner equity in their house, and people are starting to understand that. You will have a lot of demand for these lower end entry-level homes that I believe will not be affected as much as the luxury homes in terms of pricing. So if you own a middle range or low income house and you're planning to sell, you're probably still in a pretty good spot. This is what this seems to be. If you are planning to sell a luxury home, it depends on where you're at, the location, the net worth of people in your area. There are many factors involved. Again, this is national data. Markets are different. California, I know, is under a rock right now. New York is here and there. It's actually still working pretty well. Northern Virginia is still very hot. I personally invest in Virginia, which is still extremely hot. A lot of people coming towards us because of the proximity towards the sea and because of the general cost of living. Central Virginia is extremely cheap right now. People are moving there. Guys, this is all for now. I hope this gave you some good insights about the national situation. If you have some questions or if you want me to add some more data points, just hit me up in the comments section. I will take a look, see if I can find some data points and potentially add them on the next videos. Let me know what you think. Thank you for watching. Not financial advice. Ciao!